SaKong.
Well, thank you very much, Fred, for very, very warm and kind words. It is always nice to be back to PIIE to meet all good friends at one place. It is my real pleasure and honor to be here this afternoon. As Fred just said, I accompanied my president who attended the last weekend G-20 summit. As Fred said, I might talk about the G-20. Actually, since all of you must have read the communique, and there's a long reports on this G-20, so I don't think I need to get into details, but I'll make I will share with you a few of my observations on the G-20. Before doing so, I thought I should update you on the Korean economy. So I will show you some PowerPoints and just to update you by giving you a few very recent statistics on macroeconomic development and the financial situation of Korea. Here you can see that the Korean GDP growth rate in recent quarters been substantially reducing in the growth momentum. Last year we grew about 5% actually, and actually last 3 years our growth rate was at around 5% per annum. But as you can see, this year you see the very visible deceleration of our growth rate. Third quarter is just about 3.9%, and fourth quarter it'll be even lower, as you can imagine. And that's primarily due to very slowing our private consumption. As a matter of fact, today the private consumption is a proportion of GDP is less than 50% now. It used to be about 55%, but because of the continuous decrease in our private consumption, the proportion now is reduced to about below 50%. And so the private consumption is almost at the standstill. And then the construction investment, which is about 15% of our GDP, is actually a negative growth. But export is still doing okay. Our export has been growing at two-digit level, but now is also visibly decelerating. So because of this slowing growth in the components of GDP growth is decelerating substantially. But fortunately, we are not in anywhere near to recession or anything, but we try to manage our economy so that we can have the soft landing in our term. Okay, this just shows you the inflation, and as consumer prices also is actually the inflation is not really a problem, and at the end of this year, inflation rate may come down to even below 4% or somewhere. That's not much of concern, but the problem is the job creation. Currently, I think the recent months statistics on unemployment rate is still around 3%, but the this unemployment is, as you know, we follow the ILO definition. So if those who are out of market because they don't seek the jobs, they are not including the unemployment. So there are many people who are left out of the job market, so they are not included in here. But in terms of the unemployment rate, it looks not too bad. But if you look at the new jobs creation, you can see visible slowdown in our job creation numbers. And then I'll just give you the broad picture on our trade and current account situation. As you can see, our export has been growing quite a robust way, and even this year, our export has been growing at two-digit level. Not only two-digit level, it's over 20%. And the question is why? If you look at this, the composition of our export in terms of the products and in terms of the markets, it's very, very well diversified. That is the reason why U.S. economy is not doing and other major economies are not doing. Look at that, product, the composition. It's quite evenly distributed, starting from semiconductor to, the textile. And so this is one of the, but more significantly, you look at this export market composition. China is, of course, the largest trading partner for Korea now, but the EU is very important, and North America is substantially reduced, but still important. And then Central and South Africa and Japan is not that important, but still important, not as important as it used to be. But Middle East, and then others, including, Russia and the former Soviet Union countries. So for this reason, I suppose our exports are still doing quite well. And thanks to that, this current account surplus is expected in fourth quarter. Actually, we expected current account surplus, which suffered deficit third quarter, but in fourth quarter it will turn into surplus, and it will be continued to be so in next year, primarily thanks to the low oil price and the raw material price. So the KDI's forecast for next year, so the current account surplus will come near to $5 billion. Now let me turn to Korea's external position and financial strength. Because I just wanted to update you on this regard, because there are some who are concerned about Korea's financial, the industry, and the Korea's the position in the foreign exchange market area. So I just wanted to give you a very brief the overview of what in this regard. Look at this foreign exchange area. As you know, Korea's current reserve is $212 billion, which makes the sixth largest reserve holders in the world. And then some people worry about this total external debt. And if you compare to that external debt to foreign reserves, which is compared to other countries is admirably good, which is 60%, because in the debt there are many long-term debts included. And then the current external debt, which is really the debt with maturity less than 1 year, and the debt which will mature within 1 year, which compared to foreign exchange reserve is about 86%, and total external debt reserves is 173%, which is not really bad at all. You know, you compare that figures to the equivalent statistics of the end of 1997, which was immediately after with the currency crisis. There is really, you can see so much differences there. Actually, you know, by the time we had the currency crisis in 1997, our reserve was around actually $2 billion level. And but people even today, some people talk about Korea as if we're similar situation in the situation we were in 1997. But you look at these statistics, and then it's so different now. And then banking sector, you look at the non-performing loan ratio, which is substantially low, and as compared to the ratio in late 1997. And the BIS ratio, again, is over 11%. And then corporate sector also, if you look at the debt-to-equity ratio, actually, you know, Korean jewels now is actually lower than 100%, and which was a problem. And before the crisis, they had at least a 500% debt-to-equity ratio before the Asian financial crisis. So this situation is quite different. And then the interest coverage ratio, which is, you know, interest, the payments over the current earning is, again, this looks pretty good. And then foreign reserve, if you look at a little bit the detailed aspect of this, you look at this total reserve is 212 billion, which makes, as I said, the sixth largest reserve holder in the world. But some people ask, well, are Korea's foreign reserves liquid enough? If you look at this, it's over 90% as made up of bonds mostly rated AA or AAAs, including U.S. Treasury bill, the notes. And so I suppose the foreign reserves, Korean foreign reserves are liquid enough. And then the external debt, and as compared to GDP, if you look at it, it's only about 39% of GDP. And then, again, the current debt to reserves, and the short-term debt to reserve, this all the ratios also looks very good. And in fact, some other countries don't even have statistics on these short-term debts and the current debts. And then some people talked about, you know, this Korea's the default risk, which is really not really a fair assessment of the Korean situation. If you look at the composition of, again, our total debt, you know, we have about 12% of our total debt is for cash advances for shipbuilding contracts. You know, our shipbuilding industry has been doing so well, and so you get the advances. And this advance is actually not at the risk of default on the part of Korea. And then substantial, about 22% of the foreign borrowing are borrowings for hedging purposes. So again, if those two together, which is about 34%, are not at the default risk. So if you eliminate all these things, some of the very pessimistic reports, not today, but a few months ago, maybe even a month ago, they, without knowing some of these details, had very unfair assessment. That's why I just wanted to update you on this. And then another thing is, you know, interesting thing is that the Korean banks, the external debt is a substantial part of that, with the 39% or 40% are the foreign banks branches in Korea borrowing from the headquarters. So actually, it shouldn't be, again, excluded from the Korea's the external debt. Banking sector also, our loan-to-deposit ratio. Actually, our loan-to-deposit ratio, as compared to the Western banks, US or UK and Italy, and those banks are quite comparable. But compared to banks in Japan, as you can imagine, our ratio is a little bit lower. But again, the loan-to-deposit ratio doesn't look that bad at all. And then this total, the delinquency ratio for the bank loans are quite low, even for the small and medium firm loans. And then in terms of banks, the ability to deal with some unexpected situation, we still have this substantial absorptive capacity for the impact of default risk, because about 186% of coverage ratio is there still, and the LTV, loan-to-value ratio, is approximately only 47%. So unlike U.S. mortgage market, this is quite sound. And then if you look at the loan portfolio, it's quite diversified. That's another reason why we are not very much concerned about the banking sector as a whole. And then household debt. Some people talk about Koreans' household debt is too much, and the real estate bubble and so forth. So if you look at here again, Korea's household debt to GDP ratio, Korea is much lower than the other OECD member countries, US and UK and Japan. And also the household debt to financial asset ratio, Korea is actually a little bit higher. That is explained by the chart below. Below, that is the real estate to household asset ratio. Koreans, invest more in real estate, their own home, than the counterparts in this country. So if you take the real estate to household all asset, this real estate is the major item. That explains why our financial debt to financial asset ratio is higher. And here again, why then we have pretty good loan to value ratio? Because we had very strict policies implemented earlier. And look at this LTV limit, which is 40 to 60% in loan to value ratio. In the US, actually, there was almost no limit. And then Hong Kong, 60, 70%, and then again the DTI, debt to income ratio, we again had only limit to 40%. And we introduced this system in mid 2000. I think, yeah, it was introduced in 2006 or so. So we've been controlling this quite tightly. Thanks to these policies, we could avoid these problems in mortgage markets. So with this all strict policy measures, as you can see from the graph there, the LTV ratio has been steadily decreasing. In other words, today is about 47%. So the banks don't have much, the default risk here. Then why some negative perceptions on Korea? I always think that there's the two reasons. One is hard reason, that is that Korea's openness is quite high, trade dependency, is quite high, and capital market openness is quite high. You know, our trade dependency is over this 75%, which is very, very high. And the capital market, as you know, foreign share, the proportion of foreign shareholding in KOSPI, the Korean stock market listed equities, went up to as high as 42%. But many foreign investors sold off and cashed out during the last few months. So now it is down to 29%, but still it's quite high as compared to the United States, which is only 11%. And then I would say that psychologically, people still have the trauma of 1997 currency crisis. So even foreign reporters, I think, come to Korea and talk to some of the Koreans who are still worried about any possibility of having problems. And then they take that and go back, and then they talk about Koreans' own pessimism, and then they write about it, and then Koreans read about it and say, well, foreign press is very pessimistic on us. And then this goes, and get into the vicious circle. Actually, it has been happening in the past. But I think Koreans are very, very, still, vivid memory of what happened 10 years ago. So I think this is a very important factor for the negative perception. Now, let me turn to, I shouldn't spend too much time on this, government policy responses. And we had been providing this foreign currency provision because we did have some foreign exchange liquidity problem in Korea. So we utilized some of the foreign exchange reserves for the banking sector's foreign exchange liquidity supply purposes. And then thanks to U.S. Fed, we had a swap of $30 billion. Again, that helped a great deal. We really appreciate this U.S. Fed providing this kind of arrangement. And then we do have the bilateral swap line with the China and Japan, but we're for mutual benefit, we try to have the additional bilateral swap arrangements as well. And so we took various measures, as many other countries did. And fiscal stimulus package, actually so far, we had a series of stimulus packages. All put them together is about 3.7% of GDP, which is quite high. And with some, the tax reductions as well. So you get the Korea is if the total fiscal stimulus about 3.7%, Japan so far 1.2%, and China, I suppose there are some double counting. So and well about this, but still quite substantial stimulus package to be implemented. And we already did it. And then I'll tell you, we are ready to do more if necessary. And I say this because we can afford to do that. By look at this current, our fiscal strength. Korea's fiscal balance in consolidated fiscal balance is in surplus. Actually, our fiscal position is the best among OECD nations. And if you look at, again, the total debt, government debt, public debt in stock to GDP, Korea is actually, again, the lowest among most of the OECD members. And then we still have room for monetary easing, too. Although we did have the Bank of Korea's base rate cuts, but still it is at the 4% level. So we still have room for further reductions in monetary base rate if necessary. And as you can see, U.S. is already at the 1% level, right, Fed funds, and Japan, you cannot go down much further. So, if necessary, we'll take the appropriate measures in this monetary front as well. With this, before I conclude, I say that how at least the government foresee next year. Well, you know, I'm sure the Michael Musa and the global leading experts here, but we are been, you know, lowering our forecast, but still we had the baseline forecast of around 3%. It can be lower, but with the stimulus package and with the monetary easing, we try to attain our growth rate 4%, maybe a little bit too ambitious, but I think 3 to 4% is not infeasible goal to achieve. And so this is what the Korean economy look like at this point. And with this update, I will move on to the G20. For the sake of time saving, I just would read this. I wrote it last night, so I don't know what I wrote about. But well, as I said, assuming you all read this declaration, I don't think I need to get into the details. First question to raise is why the G20 summit now? Let me begin by asking why the G20 summit at this time? I suppose the answer is already in the name of the summit, and that is Summit on Financial Markets and the World Economy. The G20 leaders gathered here in Washington, D.C. over the weekend to address the current global economic and financial turmoil. Since the turmoil is global in nature and serious in its magnitude, global leaders apparently felt that there was an urgent need for global efforts. Of course, there are various behind stories, and you know, some of you know quite well how it all began. Of course, President Sarkozy came to Washington and talked with President Bush, and they came up with this G20 gathering. But in any case, I think that is a reflection of the global leaders' concern about and urgency of the current economic situation. Then the next question then is why the G20 summit instead of the traditional G7 summit? As you know, there have been many who argued that for the necessity of expanding the G7 as a global informal steering committee. We all know that Fred made the point in March 2004 at the G20 finance ministers meeting in Leipzig, Germany. In fact, Fred advocated the G20 to become a global steering committee. Congratulations, Fred. Your dream came true. French President Nicolas Sarkozy, in his address in September this year, also proposed the expansion of the G7 into a G13 or 14. Most recently, Bob Zoellick, who the World Bank president, has also suggested, I suppose right here in Peterson Institute, suggested forming a new global steering committee of the G14, although he said it should be flexible enough not to limit its members to 14. To my surprise, he didn't include Korea. I was quite disappointed and I was surprised. For every reason, Korea should be in it. I think many of you will agree with me. Because you want to make this group politically legitimate, right? And operationally effective. How can you leave Korea out? Korea is a member of OECD, and Korea has the first experience in economic development. And fortunately and unfortunately, we went through currency crisis and came out okay. What more can a member of the steering committee contribute more to the group? I think, but economic weight-wise, we're 12th or 13th largest economy in the world. I'm really surprised to see Bob Selig, a good friend, left. I'm going to see him tomorrow, and why he did that, I'll ask him. I have an appointment with him tomorrow, and I will talk about this tomorrow. Obviously, the G7 leaves out major economic and financial players from the emerging world. Consequently, the G7 is considered lacking its political legitimacy and suffering from the operational effectiveness. It is not realistic to address global economic and financial problems without active participation by those major economic players, particularly when this summit was to address the current global economic and financial turmoil. Almost 100% of the next year's growth is expected to originate from the emerging world, since most of the G7 countries will be in recession. No wonder then the Washington Post called the summit as marking historic power shift. In fact, it should be seen as the belated global recognition of the shift in the balance of economic power. Okay, then the next question is, what achievements made at the last G20 summit? Broadly speaking, the G20 summit had the agenda of two. Its first agenda aimed at how to address the still ongoing global financial crisis and to mitigate its impact on the real economy. Its second agenda focused on the issue of how to reform the existing international financial architecture to prevent and remedy similar crises in the future. With regard to the first agenda, there are already voices of disappointment since the summit did not come out with any action-oriented specific commitments to the provision of liquidity and additional fiscal stimulus in a globally concerted way, concerted manner. However, one should recognize the fact that the G20 leaders committed to, I quote, use fiscal measures to stimulate domestic demand to rapid effect as appropriate, unquote. I'm sure that when they meet again next spring, they would follow up on this commitment. It is also worth taking note that they commended the newly introduced IMF's short-term liquidity facility and pledged to review the IMF's resource for augmentation. At the same time, the leaders committed to continued what they call vigorous efforts to stabilize the financial system, for example, through swap facilities. It also requires, I suppose, close follow-up in the next meeting. I suppose those Troika nations, when they prepare the agenda, they should take note of this and they should make follow-ups. One of the important achievements of the summit, I consider, is a strong support for the revival of the WTO's DDA negotiations this year, and its commitment to stand still on introducing new protectionist measures at least for 1 year. The standstill on an issue, Korean president emphasized very much on this very point. Another important achievement, in my view, is the G20 leaders' strong commitment to an open global economy and the free market principles. I feel it is critically important because there is a grave danger of reverting to highly statist measures and overregulation at the time of severe economic and financial stress. Substantially detailed principles and an action plan have been laid out at the summit regarding the second agenda, that is, reforming the existing international financial architecture. They almost fully cover major reform areas for the regulatory and the supervisory regime and the international financial institutions, governance-related matters. Equally detailed principles were agreed on accounting standards, procyclicalities of regulatory regimes, and regulation regulation of rating agencies, international cooperation and coordination at national level supervisory agencies, etc. In reforming the IFIs, one of the immediate actions to be taken is an expansion of the membership of the Financial Stability Forum to include major emerging market economies. Again, of course, you would understand that I would insist to have Korea included in this group as well. The summit also recognized the necessity of improving the effectiveness of the IFIs by reviewing their mandates and the governance structure. There's two the important areas. I suppose the independent experts group, which will be established, will have to put this on its priority list. The independent expert groups for G20 will be established. Actually, that's included in the communique, came out yesterday. The experts group will have to pay special attention to the mandate of the IMF, I suppose, in particular. Although the issue of exchange rate regime was not mentioned in the declaration, since the global imbalance was as one of the main causes of the current financial turmoil was not specifically discussed. It is a critical reform area not to be left out. Given that the inappropriate regulatory and the supervisory regime was one of the major motivations for holding the summit at this point, it may not be too surprising to see that the declaration is rather long on these issues but short on other financial architectural issues. The G20 should be ambitious enough to prepare a well-balanced reform program for establishing new financial architecture or the Bretton Woods II, which would be suitable to the rapidly changing global economic and financial environment. We have learned from history that there is a danger in overreacting at the time of crisis. We should not be too hasty in designing new financial architecture at this time. Another significant decision of the G20 summit was the designation of the G20 finance ministers' leadership, which consists of, as Fred said, Brazil, Korea, and UK, as a de facto secretariat. And these three countries are known as the G20 Troika. The future success of the G20 will depend heavily on the leadership, I suppose. Okay, then the last question I would like to pose is, would the G20 replace the G7 as global steering committee? Answering this question, I would like to remind you again that the current G20 summit was called to address the current global economic and financial crisis. The question is therefore whether or not the G20 will remain as global steering committee after supposedly resolving the current economic problem. I hope it will come soon, but so some considered the group too unwieldy. They would like to see the G7 expanded, but the G20 is thought to be one too many. I personally like to see the G20, once it has successfully carried out the current mission, to become a steering committee. Fred Buxton advocated years ago. In conclusion, I must say that the half-day G20 summit was a success in reconfirming the principles of reform and mapping out the actions to be taken. I would therefore commend highly the initial endeavor of the G20 leaders as a historic achievement for the global community. What I'm saying is the meeting itself has a significance because it reflects the changes in global power shift, and I think it is a good beginning of the process. And in that regard, I think it is a historical event. I'm sure there is some the criticism on this, particularly on this macroeconomic policy area, but I think it is a good beginning, and so we have to commend the initiative. Thank you very much. I will end here.